So normally when you think of a used car lot, it is this chaotic, opaque asphalt bazaar.
Oh,
right?
Absolutely.
You picture the inflatable tube man just flailing in the wind.
Right.
The balloons tied to windshield wipers.
Right.
And, a salesperson who is just trying to pressure you into a rust-proofing package you absolutely do not need.
The classic dealership experience.
Exactly. And the pricing on those lots is inherently built on friction. I mean, the entire legacy system relies on information asymmetry.
Yeah, specifically on you, the buyer, not knowing what the vehicle is actually worth.
Right. Or what is wrong with it, or, what the dealer actually paid for it. But today on Talk Tickers, we are looking at a company that is actively trying to replace that hot asphalt with data centers.
Which is a massive shift.
Huge. We are diving into Carvana's massive first quarter 2026 earnings call, their shareholder letter, and the incredibly revealing Wall Street Q&A to see how they are engineering this.
Yeah, and it really requires a completely different analytical lens than looking at a traditional auto retailer.
Right, like an AutoNation or a CarMax.
Exactly. We are not just analyzing a dealership group today. I mean, we are analyzing a heavily capitalized, vertically integrated logistics and technology platform.
That just happens to move heavy metal.
Right. And if you are holding this stock in your portfolio, or, if you are considering taking a position, your biggest challenge is separating the macroeconomic noise from the actual business.
So you mean the inflation, the interest rates, gas prices, all of that?
Yeah, separating that noise from the underlying structural health of their operational machine. We really need to unpack what their actual execution tells us about their ability to scale.
So let's jump right into the headline numbers, because the top and bottom line results from this first quarter are really what define the narrative on Wall Street.
And the sheer volume is just staggering.
It honestly is. I mean, they reported selling 187,393 retail units in a single 3-month period.
Which is just a massive 40% year-over-year increase.
Right, setting a brand new company record.
Yeah.
And, just to put that physical volume into perspective, if you lined up 187,000 cars bumper to bumper, that line would stretch for roughly 500 miles.
That is a lot of metal.
It's insane.
Yep.
They're coordinating the acquisition, reconditioning, sale, and delivery of a vehicle roughly every 45 seconds, 24 hours a day.
And the physical reality of that volume is critical to grasp. I mean, in an environment where car prices remain historically elevated, right?
Very elevated.
And the average consumer's wallet is heavily stressed by just, cumulative inflation.
Oh, absolutely.
So printing a 40% volume increase in that environment is structurally significant.
It really is.
It suggests that their value proposition, the convenience of buying from your couch, avoiding the dealership negotiation, that 7-day return policy, it's overcoming the broader macroeconomic friction.
The friction that is slowing down the rest of the auto market.
Exactly.
But wait, looking at these revenue numbers against the unit sales, the math looks broken at first glance.
Yeah, it does look a bit strange.
Because they moved 40% more cars, right? But their revenue hit $6.432 billion.
Right.
Which is a 52% year-over-year increase. And usually when your revenue growth outpaces your unit growth by like 1,200 basis points, it means you aggressively hiked prices on the consumer.
Which they didn't do.
Right. Because looking at the broader market data, used car prices have actually been cooling off.
Yeah, they have.
So scanning through the source material, this looks like a gross revenue accounting quirk tied to their marketplace partners. I mean, are they just booking the full sticker price of certain partnered cars as top-line revenue instead of just taking a commission?
That is an excellent catch. And it is exactly the kind of analytical discipline an investor needs to apply when a headline revenue number looks almost too good to be true.
Right.
No, they did not suddenly gouge the consumer. The outsized revenue growth is primarily driven by how they are required to account for vehicles sourced through a specific large retail marketplace partner. Okay, let me try to translate this accounting reality because it's a bit dense.
Go for it.
If I run a digital marketplace, let's say I'm selling vintage guitars.
Okay, vintage guitars.
And someone lists a Fender Stratocaster on my site for $1,000. I might take, say, a $100 fee for facilitating the sale.
Right, a standard commission.
Exactly. Under normal net revenue accounting, I only report that $100 as my revenue. But under traditional gross revenue treatment, if I actually take physical control of that guitar, process it, and handle the fulfillment.
Which Carvana does with these cars.
Right. The accounting rules might force me to record the entire $1,000 as my top line revenue, and then I record the $900 I owe the original owner as my cost of goods sold.
Exactly.
Is that essentially what Carvana is doing with these partner vehicles?
That captures the mechanism perfectly, yeah. Because of the specific nature of this partnership arrangement, it likely involves Carvana taking on certain inventory risks or, handling the physical reconditioning and delivery of these specific third-party vehicles.
Right, doing the heavy lifting.
Yeah. So the generally accepted accounting principles, or GAAP, dictate that they must recognize the total gross transaction value as revenue.
Wow.
And that artificially inflates the total revenue figure relative to their historical baseline.
Which means as an investor, I shouldn't be throwing a party over a 52% revenue jump.
No, definitely not.
The 40% unit growth is the core fundamental metric I should actually care about. But this gross revenue quirk also messes with their margin math, doesn't it?
It absolutely does.
Because if you are suddenly dumping, billions of dollars of low margin or zero margin pass-through revenue onto your top line, your overall profit margin percentage is going to look artificially compressed.
Yeah, it creates a mathematical dilution.
Yeah.
And management actually explicitly noted this in the call.
Well, they did.
Yeah, this gross revenue treatment caused a visible decrease in their adjusted EBITDA margin percentage. It dropped it from what would have been 11.5% down to 10.4%.
Oh, wow. That's a noticeable drop.
Right. But the profit numerator, the actual dollars of adjusted EBITDA they generated, hit a record $672 million.
Okay, so the cash is there.
Exactly. But because the revenue denominator swelled so disproportionately, the margin percentage shrank.
And I mean, $672 million in adjusted EBITDA is not a small number.
Not at all.
Because adjusted EBITDA is basically their cash flow proxy. Right?
Yeah.
It tells us how much cash the core business is throwing off before we worry about taxes or, depreciation on their real estate and the interest on their debt.
Right, the core operational cash.
And that GAAP operating income landed at $581 million, which is another all-time record.
Yeah.
So despite the accounting noise on the top line, the actual cash generation of the business is clearly accelerating.
And that cash generation is vital because Carvana still carries a significant debt load from their hypergrowth phase a few years ago.
Right, that debt was a massive concern for Wall Street.
Exactly. So generating nearly $600 million in operating income in a single quarter proves that they can comfortably service that debt.
Yeah.
And they can organically fund their future expansion without constantly going back to the capital markets to dilute shareholders.
Which is huge for the retail investor listening.
It really is. What is truly fascinating here is that we are looking at the 9th consecutive quarter where this company has led the entire automotive retail industry in both retail unit growth and profit margins.
9th consecutive.
Totally.
That is wild. But, there is a tension in these numbers.
Whoa.
Yeah, during the Q&A, an analyst named Marvin pointed out a really interesting inventory quirk.
Right. I remember that.
While their sales grew by 40%, their standing inventory of cars only grew by a little over 30%.
Yeah, it lagged.
And if you are a retailer and you are selling your products significantly faster than you are restocking your shelves, you eventually hit a wall. Right?
You run out of stuff to sell.
Exactly. You run out of cars.
Yeah.
So why are they letting their inventory lag their sales growth?
Well, it exposes a critical operational dynamic specific to the first quarter.
Okay.
The first quarter in the used car business is heavily dominated by tax refund season.
Ah, right.
Yeah, when consumers get their tax refunds from the IRS, there's this massive, sudden influx of down payments into the auto market. Demand just spikes aggressively.
People finally have the cash for a down payment.
Exactly. And CEO Ernie Garcia addressed Marvin's question directly. He noted that if they possessed a magic button to instantly materialize tens of thousands of fully reconditioned frontline ready vehicles,
They would have pushed it.
yeah, they could have easily satisfied even more demand and driven that 40% growth number even higher.
But the reality is, acquiring and fixing used cars is a complex physical process. You can't just spin up a new server instance to get more cars.
Right, it's heavy metal.
You have to send out trucks to buy them from driveways or, outbid other dealers at wholesale auctions. And then you actually have to put them through the repair shops.
It takes time.
So they are running a bit lean, but doesn't keeping inventory lean also serve as a massive protective shield for their balance sheet?
It absolutely does.
Because used cars are depreciating assets. They are not fine wine. They do not get better with age.
Sadly, no.
If you hold a used SUV on your lot for 90 days, the market value of that vehicle is dropping every single week.
Yeah, the depreciation curve is basically the silent killer in auto retail.
Right.
By running a structurally lean inventory and turning their stock over rapidly, they drastically reduce their exposure to that depreciation risk.
It's a trade-off.
It is a totally calculated trade-off. Yes, a lean inventory might slightly constrain their absolute maximum top-line sales growth during peak demand windows like tax season, but it protects their margins and their balance sheet.
Which is arguably more important right now.
Exactly. And the fact that they still achieved 40% unit growth while their inventory was lagging, that proves that their operational machine is moving with incredible velocity.
Which brings us perfectly to the operational machine itself, the story behind the numbers. Because selling 187,000 cars online is, honestly, the easy part of their business model.
Building a slick website is just software.
Right. Processing loan applications is just software. The hard part, the intensely difficult, capital-crushing part, is acquiring those unique vehicles, fixing their brakes, painting their bumpers, and physically trucking them to a driveway in a different state.
Yeah, the physical world is messy.
Very messy. So to understand how they squeeze $672 million of profit out of this process, we really have to shift our focus from the financial spreadsheet down to the factory floor.
And that distinction between a pure e-commerce software company and a heavy industrial logistics company is exactly where the Carvana thesis is tested.
Right.
And this is where we have to examine the bump in the road that management was surprisingly transparent about regarding the previous quarter.
Right, the snag in Q4. Management actually admitted that back in the fourth quarter, their vehicle reconditioning process, or recon as they call it internally, hit a major bottleneck.
And recon is the absolute beating heart of their profit engine.
It really is.
Yeah.
Because if you buy a used car from a customer, it is almost never perfect.
Never.
It have door dings, it needs an oil change, the tires are bald, maybe the interior smells like wet dog.
Yeah, it happens.
Carvana has to fix all of that up to a rigorous, standardized cosmetic and mechanical level so that a new buyer feels entirely comfortable purchasing it sight unseen on their phone.
Right.
And if the recon facilities slow down, the flow of inventory stops, the website looks empty, and the whole company just stalls.
Yeah, and scaling reconditioning is uniquely difficult because you are dealing with infinite variability.
What do you mean by that?
Well, unlike a traditional factory that builds the exact same widget 1,000 times a day, every single used car rolling into a Carvana recon facility is a unique puzzle.
Oh, I see.
A 2018 Honda Civic might just need wiper blades and a wash, while the 2021 Ford F-150 right behind it on the line needs a transmission repair and a complex paint blend on a scratched quarter panel.
Totally different workflow.
Exactly. And in the fourth quarter, management realized that the variance in performance across their nationwide network of these massive recon facilities was simply too wide.
So what actually broke? Did they just, not have enough mechanics?
No, it wasn't a lack of raw manpower. It was actually a breakdown in routing and decision-making at the management level.
Okay, how so?
They identified that as they rapidly scaled up hiring to meet demand, the newer managers in certain locations lacked the granular data visibility and the sophisticated software tools required to execute efficiently.
That makes sense.
Because when you have a massive facility with hundreds of bays and you have 30 technicians on a shift with entirely different skill sets, some are master mechanics, some are solely cosmetic painters, some are interior detailers. How do you route the flow of hundreds of broken cars to keep every single technician fully utilized without creating a massive traffic jam outside the paint booth?
Right, because if the painter is waiting for the mechanic to finish the brakes, the painter is just standing around costing the company money.
Exactly.
And the car isn't getting listed on the website. So how did they flip that narrative so fast? Because usually when a company blames operational bottlenecks, it takes them 4 to 6 quarters to right the ship.
Yeah, it's usually a long excuse.
But instead of faltering or, blaming the macro environment like so many legacy auto dealers do, Carvana actually sent their software developers physically down to the factory floor.
And that deployment of their product and engineering teams into the physical recon centers is just a fascinating case study in their corporate culture.
I love that they did that.
The developers didn't stay in their corporate silo in Arizona, attempting to write code based on abstract reports. They spent weeks on the ground in the specific facilities that were underperforming.
Getting their hands dirty, essentially.
Yeah. They physically observed the bottlenecks. They watched how long it took for a car to move from the mechanical inspection bay to the cosmetic repair line. And then they built new data integrations directly into their proprietary operations software,
which they call Carly.
Yes, Carly.
Let's dig into that Carly software, because I think a lot of people just assume Carvana uses off-the-shelf dealership management software.
Right, like CDK or something.
Yeah, exactly. But Carly is completely custom, built in-house.
Right, completely in-house.
They essentially build a highly quantitative air traffic control system for used cars. It tells the floor manager exactly which car to move to which bay based on the real-time availability of specific technicians and the time-motion constraints of the required repairs.
Precisely. They created productivity trackers and dynamic routing algorithms that provide instant feedback loops.
Give me an example of how that works.
Well, if a specific type of brake repair is consistently taking 20 minutes longer than the modeled expectation at a facility in Ohio, the software flags it immediately. Yeah, so management can intervene. Perhaps the mechanics need a different tool, or perhaps the parts procurement process for that specific brake pad is delayed.
That is incredible visibility.
It is. And by tightly integrating software with physical labor, CEO Ernie Garcia stated that by April, their labor efficiency across the entire nationwide network was operating just shy of its all-time best.
That's a fast turnaround.
Yeah, they solved a massive physical scaling problem in a matter of months using code.
And we can see the sheer power of that operational leverage showing up directly in their SG&A line, their selling, general, and administrative expenses.
It's all right there in the numbers.
Because for an investor, the SG&A line is arguably the most important metric to watch on Carvana's income statement right now. This is where the actual scalable profit is generated.
Yes, absolutely.
In the first quarter, their operations expenses dropped by $36 for every single retail unit sold. But the truly massive number is that their overhead expenses plummeted by $226 per retail unit.
And when you combine those, every single vehicle they sell is now carrying $262 less in corporate and operational baggage than it was just 12 months ago.
That is a massive margin boost.
It is. In a business where you are dealing with thin physical margins on the asset itself, stripping out $260 of internal friction per transaction is exactly how you generate that $672 million in adjusted EBITDA.
It falls straight to the bottom line.
Exactly.
To explain how this SG&A leverage actually works in practice, let's look at it through a real estate lens.
Okay.
Imagine you're in the business of flipping houses.
Right.
To run this business, you have to buy expensive heavy machinery, you rent a massive warehouse to store your lumber and drywall, and you hire a full-time architect on salary.
Your basic fixed costs.
Right. Those are your fixed overhead costs.
Yep.
You have to pay them regardless of how much work you actually do. Now, if your company only flips one single house this year, that one house has to generate enough profit to pay for the entire warehouse lease, all the machinery, and the architect's full salary.
So your profit margin on that house is going to be terrible.
Awful. But if you implement better software, work faster, and figure out how to flip 100 houses a year using that exact same warehouse and the exact same architect, those massive fixed costs get spread out over 100 transactions.
Right. The per unit cost drops.
The overhead costs assigned to each individual house drops to almost nothing. You're essentially printing pure profit on that extra volume. And that is exactly what Carvana is doing with their corporate headquarters, their proprietary software development costs, and their national logistics network.
Yeah, the fixed cost absorption model is central to their long-term thesis. And management was very explicit that their overhead expenses are largely fixed in nature at this point.
They've already built the machine.
Exactly. They have already built the core corporate infrastructure needed to support a massive enterprise. Yes, there will be marginal incremental costs as they scale. They might invest in new artificial intelligence tools for automated vehicle inspection. Or they might incur seasonal variable costs, like the higher than expected snow plowing costs at their Midwestern logistics hubs this winter.
Right. Snow happens.
But the heavy lifting is done. The more volume they push through this fixed infrastructure, the more that per unit overhead costs will compress.
But it's not just about minimizing cost, is it? It's about maximizing speed. Because in the car business, speed is literally money.
It absolutely is.
The faster you turn a car, The less depreciation you eat, the less floor plan interest you pay to finance the inventory, and the faster you free up capital to buy the next car.
Velocity is everything.
And during the Q&A, Ernie Garcia shared an anecdote about their fastest end-to-end transaction for the quarter. I really want to walk through the timeline of this logistical ballet, because when you break down the physical steps involved, taking only 4.8 days is almost unbelievable.
Yeah, the 4.8-day end-to-end metric is just a stunning validation of the capital expenditures they made over the last decade. It proves the system works exactly as designed.
Let's think about the friction in this process. Day 0. A customer goes onto the Carvana website, inputs the license plate of their old car, answers a few questions about its condition, and the algorithm instantly generates a firm cash offer.
Right.
The customer clicks accept. Day 1. Carvana handles all the digital title work with the DMV, dispatches a local hauler to the customer's driveway, physically picks up the vehicle, and transports it to a local aggregation hub.
And that's just the start.
Yeah. Day 2. The car is loaded onto one of Carvana's massive proprietary 9-car haulers, which, by the way, are routed using their own traveling salesperson algorithms to optimize fuel and time.
Naturally.
And it is driven hundreds of miles to a massive inspection and reconditioning center.
And that is just the transport phase. Then the actual industrial work begins.
Right. Day 3. The car enters the recon facility. It is hooked up to OBD2 scanners to pull engine codes. Mechanic put it on a lift, inspect the suspension, change the oil, replace the worn brake pads.
It moves to the cosmetic line.
Yes, where painters blend away the bumper scratches. It goes through a rigorous interior detailing process.
Then the photos.
Day 4, it rolls into their proprietary 360-degree automated photo booth. The cameras map the entire vehicle, highlighting any remaining minor imperfections for full transparency.
Which builds trust.
Exactly. The images are uploaded to the cloud. The AI pricing algorithm sets the retail price based on real-time market data, and the car goes live on the website. Day 4.5. A totally different customer, maybe 3 states away, browses the site, finds the car, applies for financing, gets instantly approved by Carvana's automated underwriting engine, and clicks buy.
Wow.
Day 4.8. Carvana loads that freshly detailed car onto another delivery truck and drops it off at the new buyer's house. All of that physical movement, mechanical repair, bureaucratic title processing, and financial underwriting took 4.8 days.
And if you contrast that 4.8-day timeline with the traditional dealership model, the competitive advantage becomes glaringly obvious.
Oh, it's night and day.
A traditional dealer has to wait for a customer to wander onto their specific lot, negotiate the trade-in, let that traded-in vehicle sit on the back lot until a local mechanic has free time to look at it.
Which could take a week.
Right. Eventually list it online, and then hope another local buyer happens to walk onto the lot looking for that exact make and model. Carvana is operating a national liquid marketplace where inventory velocity is their primary weapon.
And a few years ago, Wall Street absolutely punished Carvana for overbuilding this infrastructure.
They really did.
They were ridiculed for spending billions on these massive automated reconditioning centers and their own fleet of trucks when they didn't have the sales volume to justify it.
But now that infrastructure is the moat.
Exactly. You cannot replicate a 4.8-day national turn time without owning the trucks and the physical real estate.
That vertical integration is key. They aren't relying on third-party transport companies whose incentives aren't aligned with Carvana's speed requirements.
Right. Third parties don't care about your 4.8-day metric.
They control the entire logistical chain. And a massive piece of that physical infrastructure puzzle is the ADESA network, which they acquired a few years ago and mentioned prominently in the shareholder letter. We really need to explore ADESA and their new ADESA Clear platform.
Yes, we do.
Because it represents a massive secondary revenue stream that most retail investors completely overlook.
Right, the wholesale market. For context, if Carvana buys a car from a customer, but that car is, say, 10 years old, has 150,000 miles on it, and the transmission is slipping.
They aren't going to fix that.
No, they're not going to spend the time and money to recondition it, and they certainly aren't going to risk their brand reputation by selling it to a retail customer. They have to dump it, they wholesale it.
Yep.
Historically, they would send these junker cars to physical wholesale auctions where independent car dealers gather to bid on cheap inventory.
Exactly. And the wholesale auction market is a massive, incredibly lucrative, yet highly analog ecosystem in the United States.
Very analog.
Mannheim and ADESA were historically the two dominant players, operating these massive physical parking lots across the country where dealers would literally physically walk around kicking tires and bidding in person.
Right.
Carvana bought the entire ADESA U.S. physical auction network. And they didn't just do it to enter the auction business, they bought it for the strategic real estate. ADESA gave them 56 massive physical locations, representing millions of square feet of industrially zoned paved real estate located precisely near major population centers.
Which is incredibly hard to find.
Yeah. They bought the land to build out their retail reconditioning footprint, but they also acquired the legacy wholesale auction business that operated on that land.
And now they're completely transforming that legacy auction business with software, which they're calling ADESA Clear. Instead of forcing dealers to physically drive to the auction lot to bid on Carvana's cast-off vehicles, they built a best-in-class digital auction platform.
And what is brilliant about the ADESA Clear rollout is how they leverage their own immense scale to force adoption.
What do you mean by force adoption?
Well, usually if you build a new digital marketplace, your biggest hurdle is the cold start problem.
Like Uber or Airbnb had.
Exactly. You have to spend a fortune marketing to convince sellers to list their products and simultaneously spend a fortune convincing buyers to show up.
Right, the chicken and egg problem.
But Carvana bypassed the cold start problem entirely. Because Carvana already acts as one of the largest single sellers of wholesale vehicles in the country, they simply poured all of their own massive wholesale inventory exclusively into the ADESA Clear app.
Oh, that's smart.
If an independent dealer wanted to buy Carvana's wholesale cast-offs, they had to download the app and use the digital platform.
They forced the digital transition by controlling the supply.
Yes, they did.
And Ernie Garcia noted that simplifying the software development, focusing strictly on making the app work flawlessly for their own inventory first, rather than trying to accommodate thousands of different sellers with different data formats, it allowed them to build a vastly superior product quickly.
It was a very strategic constraint.
And the financial result is striking. Their wholesale vehicle gross profit per unit actually increased.
Wow.
By modernizing the auction process and reaching a wider digital network of buyers, they are driving up the bidding prices. They're literally making more money on the broken cars they don't even want to keep.
It creates a powerful dual flywheel effect. I mean, they are getting faster and more profitable at their core retail business while simultaneously building a digital moat and expanding margins in the wholesale ecosystem.
Right.
They are monetizing the vehicles at every single stage of their life cycle.
And that dual efficiency brings me to another fascinating line item in their SG&A expenses: advertising.
Ah, yes. The ad spend.
While their operations costs and their corporate overhead costs are dropping dramatically per unit, their advertising expense actually went the other direction. It increased by $92 per retail unit sold.
It did.
So if the brand is gaining so much traction and they are setting sales records, why are they spending significantly more money to acquire each customer? Is their customer acquisition cost fundamentally broken? Or is this like a deliberate strategic choice?
It is entirely a deliberate strategic choice, and management was very careful to frame this narrative for the analysts.
How so?
Carvana does not view their current market position as mature. Despite the massive absolute numbers, selling nearly 800,000 cars a year on an annualized basis, they repeatedly emphasize that their market share is still only hovering around 2% of the total U.S. used vehicle retail market.
2%. That sounds incredibly small when you consider how ubiquitous their brand feels.
I know. It highlights the extreme fragmentation of auto retail. The largest legacy dealer groups in the country barely command low single-digit market shares.
Wow.
Carvana looks at other retail sectors like electronics, apparel, or books, where e-commerce penetration frequently exceeds 20%.
Right, like Amazon, basically.
Yeah. And they firmly believe that automotive retail is eventually heading toward that same 20% digital adoption curve.
Okay, I think.
Therefore, they view advertising not as an operational expense to be minimized right now, but as an aggressive investment in a long-term growth pillar.
They want that 20%.
Exactly. They are willingly leaning into heavier ad spend to aggressively capture more of that 2% market share, knowing full well that their underlying operational costs, the recon efficiency, the ADESA Clear margins, the logistics network are dropping fast enough to easily absorb that extra marketing cost while still printing record profitability.
They're basically strategically pulling the levers of profitability. They have the margin cushion to buy growth.
Exactly.
And that transitions us perfectly into understanding management's guidance.
Right, the outlook.
Because we have established that the operational machine is running incredibly well right now. But as an investor, you aren't paying for yesterday's profits. You are paying for tomorrow's cash flows. What does the windshield look like for the rest of 2026?
Well, the guidance is where we see management's confidence, but also their acute awareness of the macroeconomic risks they really cannot control.
Okay.
For the second quarter, they provided an incredibly strong outlook. They're expecting a sequential increase in both retail units sold and adjusted EBITDA. They are openly anticipating that Q2 will shatter the all-time records they just set in Q1.
That is a massive flex to Wall Street.
Yeah.
They are essentially saying, you were impressed by the 187,000 cars and the $672 million we just printed. Just wait until you see the next quarter.
It is a highly confident posture, but they immediately followed it with a necessary caveat regarding the macroeconomic environment.
And why was a catch?
They pointed out a specific headwind that analysts and investors need to model into their Q2 expectations. While overall EBITDA will grow, they expect their retail GPU, the gross profit per unit, generated specifically from selling the car to the consumer, to experience a year-over-year decrease in the second quarter.
Yes, the retail GPU headwind. And they broke this expected margin compression down into two very specific buckets, which I really want to unpack, because they teach us a lot about the weird economics of the auto industry.
They really do.
First, they said roughly $100 of this upcoming margin decrease is simply due to a lack of tariff-related benefits that they enjoyed in the same quarter last year.
Right.
Now, tariffs are just taxes levied by the government on imported goods. If the U.S. slaps heavy tariffs on imported foreign cars or imported auto parts, it artificially restricts the supply or raises the price of new cars.
That causes a chain reaction.
Exactly. When new cars get more expensive or harder to find, consumers naturally flood into the used car market, which artificially props up domestic used car values. It sounds like last year, Carvana got a margin boost from this tariff-driven artificial scarcity.
Yes.
This year, that artificial macro boost is gone, so their margins look a little lighter on a year-over-year comparison. Is that fair?
That is the correct interpretation. It is purely a year-over-year comparison issue. When analyzing a company, you must isolate and strip away the one-time transient macroeconomic benefits from the prior year to understand the true operational baseline of the business today.
Make sure you're comparing apples to apples.
Exactly. They aren't actually losing operational efficiency. They just aren't getting that free macro tailwind anymore. But the second bucket of the headwind is far more complex and, frankly, far more interesting to analyze because it goes to the core mechanics of how they source inventory.
Oh, the spread compression.
Yeah. They expect another $100 to $200 of margin compression stemming from what they called narrower industry-wide wholesale-to-retail spreads.
Okay, narrower industry-wide wholesale-to-retail spreads is a textbook example of Wall Street jargon that makes retail investors' eyes just glaze over.
It is a bit much.
Let's translate that into something tangible. Imagine you run a local grocery store.
Okay.
Your business model is simple. You buy tomatoes wholesale from a massive farm, and you sell them retail to your neighborhood shoppers at a markup. Everything is going great. But suddenly, there is a terrible freeze in Florida, the tomato harvest is ruined, and the wholesale cost of tomatoes spikes dramatically overnight.
Right, a supply shock.
Exactly. To keep your shelves stocked, you have to pay the farm significantly more money. But your neighborhood retail shoppers, they are stubborn. They refuse to pay $5 for a tomato at the register.
They want the old price.
They expect tomatoes to cost what they have always cost. If you raise the price too fast, they just won't buy them. So until the retail shoppers accept the new reality of the market and retail prices slowly creep up to catch up to the wholesale spike, your grocery store has to eat that margin difference.
Right.
You make significantly less profit per tomato. That is exactly what is happening in the used car market right now.
The grocery store analogy is conceptually excellent, but when we apply it to cars, we have to add the severe risk of depreciation. A tomato rots, but a $30,000 SUV depreciates by hundreds of dollars every week. It sits unsold while you wait for that retail price to catch up.
Ouch.
The dynamic management described is rooted in the velocity of the wholesale market versus the sluggishness of the retail consumer. Early in the first quarter, anticipating the tax season demand, wholesale prices for used cars, the prices dealers pay each other at auctions like ADESA, ran incredibly hot.
Dealers were overpaying.
Yeah, prices appreciated faster and earlier in the year than historical norms would suggest. Carvana, because they need to feed their massive sales engine, had to wade into that hot wholesale market and pay those elevated prices to acquire inventory.
But the retail consumer on the other end of the transaction is already completely exhausted.
Oh, completely.
They have been squeezed by years of compounding inflation. Their credit card debt is high. And most importantly, auto loan interest rates are sitting at multi-year highs.
Yeah.
A consumer financing a $25,000 car today at 9% interest has a drastically different monthly payment than they did 3 years ago at 3%. So the consumer simply cannot absorb a sudden spike in retail prices.
Exactly. The retail pricing is heavily lagging behind the wholesale reality. The consumer's wallet is acting as a hard ceiling on retail price elasticity.
Right.
Therefore, the spread, the profit margin sitting between Carvana's wholesale acquisition cost and their final retail selling price is being severely compressed in the middle.
And this dynamic actually prompted one of the most critical questions of the call from an analyst. I believe it was Brian Nagel.
Yes, Brian Nagel.
He essentially asked, is this spread compression a permanent structural shift in the automotive market because the consumer is finally tapped out, or is this just a temporary blip?
And Ernie Garcia's response was definitive and highly analytical. He views this compression as entirely transitory.
Transitory. There's that word again.
Right. In the automotive market, you frequently see these dislocations between wholesale and retail pricing, but they are almost always a lag effect. The market forces eventually correct the imbalance.
How does it correct?
He expects that over the next 30 to 60 days, either retail prices will slowly inch up to reflect the higher acquisition costs, or more likely, the hot wholesale market will cool down and prices will revert to the mean as the tax season demand subsides.
Makes sense.
This dynamic raises a vital lesson for retail investors. You must learn to separate short-term, quarter-to-quarter macroeconomic noise from a company's long-term structural competitive advantage.
Right, because if you believe in the company, you do not panic and sell your stock just because they're going to lose $100 of profit margin on a $25,000 vehicle for one specific quarter due to a well-understood temporary market lag.
It's just a blip.
You have to keep your eye on the overarching prize. And management was not shy about defining exactly what that prize is. They explicitly reiterated their massive long-term operating goal. They intend to sell 3 million cars per year while achieving a 13.5% adjusted EBITDA margin by the years 2030 to 2035.
And we really need to pause and put that 3 million figure into proper context, because it is an audacious target.
Oh, it's huge.
They just proudly announced a brand new all-time company record by selling roughly 187,000 units in a quarter. If you annualize that record, they are currently selling under 800,000 units a year.
Right.
Management is projecting that they will roughly quadruple their current record-breaking volume over the next 6 to 9 years, while simultaneously expanding their profit margin from the current 10.4% up to 13.5%.
That is hyper-growth forecasting.
Yeah.
And anytime a company tells you they are going to quadruple their physical output, it immediately raises a massive red flag regarding capital expenditure or CapEx.
That absolutely does.
Because if you are going to recondition and deliver 4 times as many cars, you logically need 4 times as much physical space, 4 times as many paint booths, and 4 times as many trucks.
Yeah, you need the infrastructure.
And an analyst named Daniela Higgins correctly pushed them on this exact vulnerability. She noted that according to their own metrics, Carvana is currently only utilizing about 20% of their existing real estate capacity to hit that 3 million unit goal.
Right.
But eventually, to hit the goal, they will need to build out the other 80%. How much is that going to cost, and is it going to bankrupt them before they get there?
It is the existential question for any infrastructure-heavy growth company. Can you fund your expansion without destroying your balance sheet?
Yeah, can you afford it?
Chief Financial Officer Mark Jenkins stepped in and laid out a highly disciplined, tiered strategy for their capacity expansion that should give investors a lot of comfort.
What's the plan?
He explicitly stated that they are not going to repeat the mistakes of their past by preemptively pouring concrete for massively expensive, brand new greenfield reconditioning centers.
Because they learned the hard way that building massive facilities before you have the demand to fill them is a great way to incinerate shareholder capital.
Precisely. Their CapEx strategy is now entirely modular. Their absolute first priority, the first tier of expansion, is simply adding more human capital to their existing underutilized facilities.
Okay.
If a recon center currently runs one shift of mechanics 5 days a week, they will expand to 2 shifts, 7 days a week. That dramatically increases their throughput while requiring absolutely zero new capital expenditure on real estate.
Zero CapEx is the best kind of CapEx.
Yeah.
You are just squeezing more juice out of the orange you already bought.
Once those existing facilities are truly maxed out on a multi-shift basis, they move to the second tier. This involves taking some of those massive physical ADESA auction sites they acquired and deploying their proprietary Carly software and some light, inexpensive tooling into existing garages on those properties.
Clever.
Again, this is a highly capital-light way to spin up new recon capacity. The third and final tier, which they won't trigger until demand absolutely necessitates it, is executing full architectural build-outs on the ADESA real estate, expanding the physical structures that are already standing.
Right.
It is a highly disciplined, sequential approach to capital allocation. It ensures they never overexpand their physical footprint ahead of actual, realized consumer demand.
It shows real corporate maturity. They are still forecasting aggressive growth, but they are executing that growth incredibly cautiously on the physical side while letting the digital and software sides run fast.
Very true.
But speaking of the unpredictable macro environment, we have to touch on consumer demand shifts, particularly regarding gas prices, because this came up multiple times in the Q&A from different analysts.
Yeah, that's a big factor.
The automotive market is incredibly sensitive to the price at the pump. When gas prices spike, consumers historically dump their massive fuel-inefficient SUVs and scramble to buy compact cars or electric vehicles.
We see it every time.
Does that kind of rapid chaos in consumer preference hurt Carvana? I mean, if everyone suddenly wants an EV, are they stuck holding the bag on thousands of SUVs they can't sell?
Well, the short answer from management is that, yes, they absolutely see these shifts in real-time data. Over the quarter, as gas prices fluctuated, they noted a slight but mathematically significant decrease in the percentage of large SUVs sold, with a corresponding uptick in EV and hybrid demand.
So the shift is happening.
Yes. But what is truly fascinating is not the shift itself, but how Carvana's system is uniquely designed to mitigate that inventory risk.
How so?
Because they operate a single, unified, nationwide network, and because their inventory turn times are so incredibly fast, remember that 4.8-day end-to-end metric.
Right.
Their pricing and acquisition algorithms can adapt almost instantly to changing consumer sentiment.
I love the visual of this. It's like watching a massive flock of birds instantly change direction in the sky.
Yes.
If the Carvana algorithms detect that consumers in Texas are suddenly searching for hybrid sedans instead of V8 trucks because gas just hit $4 a gallon, the system doesn't wait for a monthly management meeting to adjust strategy.
No, it's instantaneous.
It immediately autonomously tweaks the bidding software to pay slightly less for trucks at auction and slightly more for sedans. It then geographically routes the newly acquired sedans directly to the hubs in Texas to meet the localized demand spike.
That is the power of a centralized algorithmic marketplace. A traditional localized dealership is geographically trapped.
Right.
If they have a physical lot full of trucks when gas prices spike, they are stuck paying floor plan interest on depreciating assets for 6 months until they capitulate and sell them at a massive loss. But Carvana's inventory turns over so rapidly that these macroeconomic shifts in consumer preference don't present a structural risk. Rather, they present an opportunity for algorithmic arbitrage. The system is inherently designed to be adaptive.
Okay, we have digested a massive amount of information. We have broken down the staggering headline data. We have walked the factory floor to understand the operational software, fixing the reconditioning bottlenecks. We have explored the digital moat of ADESA Clear, and we have analyzed the complex macro headwinds and their disciplined CapEx guidance.
We covered a lot of ground.
Now, it is time for the signature Talk Ticker's actionable verdict. What does all of this actually mean for the retail investor listening to this right now? If you hold this stock, or if you're staring at the ticker symbol thinking about buying, what is the bottom line?
It required synthesizing all these disparate operational data points into a single, clear investment thesis. We really have to weigh the impressive internal execution against the external macro risks.
Right. My opinionated verdict on this quarter is unapologetically bullish.
You're strongly bullish. Okay.
For the retail investor, this earnings call proved one fundamental overriding reality. Carvana is becoming an absolute master of operational leverage. Think about the headwinds they face this quarter. Used car prices are still painfully high, keeping lower-income buyers completely out of the market.
Sure.
Cumulative inflation is squeezing the middle-class wallet. Auto loan rates are making monthly payments astronomical. And yet, despite all of that friction, Carvana's system absorbed the shocks, adapted its inventory, increased its unit volume by 40%, and spit out record-breaking cash flow.
I agree with the bullish sentiment, but I would really frame it around the deepening of their competitive moat.
Tell me more about that.
When a company can achieve 40% volume growth while simultaneously driving their internal operations and overhead expenses per unit down to all-time lows, you are not just witnessing a good quarter.
Right.
You're witnessing the maturation of a dominant platform. Furthermore, their rapid success in deploying tools like ADESA Clear proves that their software expertise is transferable.
Oh, that's a good point.
They can innovate beyond their core retail consumer offering and extract massive value from the legacy wholesale ecosystem as well. They are building a toll road that monetizes the movement of vehicles across the entire secondary market.
Exactly. My actionable takeaway for you, the listener, is this. Ignore the short-term macro noise. Do not panic if the stock takes a hit next quarter, because retail GPU drops by $100 due to a temporary lag between wholesale costs and retail pricing.
The macro environment will always fluctuate.
Always. Keep your eyes locked on the fundamental metrics that actually matter: unit growth and operational efficiency. Watch how much metal they move and watch how cheaply they move it.
Yes.
If they continue to heavily lever their fixed costs, if that metaphorical warehouse is efficiently flipping 100 houses instead of 10, the mathematical path to their 13.5% margin goal is crystal clear.
It really is.
They have a massive runway ahead of them to capture that 20% e-commerce market share. And after the near-death experience of their hyper-growth phase, they finally seem to possess the rigorous operational discipline required to actually fly the plane.
The necessary caveat to that bullishness, of course, is the risk of execution failure.
Right, it's not a guaranteed win.
As Ernie Garcia candidly admitted, growing a heavily physical, operationally complex business at 40% year over year is inherently dangerously difficult.
Yes, things will break.
There will inevitably be other internal bumps in the road as they stretch their systems to handle millions of cars. The true test of the long-term thesis is whether their corporate culture of rapid, data-driven problem-solving, the intensity that allowed their software engineers to fix the Q4 reconditioning snag in just a few months, remains intact as the headcount grows.
That's the real test.
But based on the overwhelming evidence presented in this specific quarter, the operational trajectory is undeniably positive.
It is a machine that is finally humming in perfect rhythm. But before we wrap up this deep dive, I want to leave you with a completely new angle. Something to chew on that was extracted from a very brief, almost throwaway moment at the very end of the Q&A session.
Oh, I know what you're talking about.
It is something that almost no one on Wall Street is pricing into the stock right now.
It was a highly speculative question, but the implications of the answer are incredibly intriguing if you look out a decade into the future.
An analyst from North Coast Research asked Ernie Garcia about the future of mobility. Specifically, they asked about autonomous vehicles.
Right.
Think about this for a second. Self-driving taxi fleets from companies like Waymo and Cruise are already rolling out in more and more cities. The technology is inevitably going to scale, but those autonomous fleets require massive, incredibly expensive physical infrastructure.
They don't just fix themselves.
Exactly.
Yeah.
A robotaxi needs a physical place to be parked, washed, mechanically inspected, repaired, and redeployed every single night.
And who currently owns a fully integrated nationwide network of massive reconditioning centers, geographically positioned near major urban hubs, staffed with thousands of trained mechanics, integrated with advanced algorithmic routing software, and supported by a proprietary fleet of multi-car haulers.
Carvana. The analyst explicitly asked if Carvana has game planned the potential of utilizing their massive infrastructure to become the underlying physical service provider for these future autonomous fleets.
That's a huge idea.
Now, Ernie Garcia gave a very measured, appropriate CEO answer. He said they're keeping their primary laser focus entirely on dominating the retail used car business for the foreseeable future, because that opportunity alone is massive.
Right, focus on the core business.
But he admitted, and I quote, "We are always paying attention."
We're always paying attention is classic corporate code for we have certainly run the models and debated the immense option value of our physical infrastructure beyond our current retail business model.
Oh, definitely.
If you force yourself to view Carvana not just as a website that sells used Hondas, but as a heavily heavily capitalized, highly optimized logistics and reconditioning API for the physical world, the potential value of that network becomes vast.
So here's my final thought for you, the listener, to mull over. If Carvana is already moving, inspecting, and repairing hundreds of thousands of complex vehicles with algorithmic precision today, what happens to their fundamental valuation if, 10 years from now, they eventually pivot to become the underlying physical operating system for the entire self-driving revolution?
It changes the math entirely.
It completely changes the math of the company. So think about that the next time you see one of those sleek multi-car Carvana haulers roll by you on the highway. Is it just delivering a used SUV to a driveway, or are you looking at a critical node in the future of all automotive logistics? Because underneath that murky, historically chaotic surface of the used car industry, they are building a very precise, very powerful machine.
A synchronized assembly line indeed.
Thanks for joining us on this Stock Tickers Deep Dive. Keep researching, stay curious, and we will see you next time.